Hi, everyone. We would now like to talk about the differences between Ind AS versus the earlier AS, right? The Indian GAAP. So there was no equivalent or a related standard as far as the preparation of financial statements as a separate financial statement was concerned, right? But then when you look at the Ind AS, there is no mandate, to follow Ind AS straightforward, and it would be prepared in accordance with all applicable Ind AS, and accordingly those measurements are done. Either you show it at cost or as per the Ind AS 109, unless it's, for example, a kind of a disposal group. If it's held for sale, then you apply Ind AS 105 measurement criteria. Okay. As far as the dividend is concerned, as we discussed, that when the right to receive the dividend is established, that's how you start. That's where you start treating the dividend as an income, right? And finally, for the disclosure requirements, that's more to do with the Ind AS 112 again, right? So in case entity does not prepare the consolidated but only separate financial statements, then all those relevant disclosure, etc., need to be also provided. Okay. What I would like to cover also is the questions that we have from this particular topic to apply our knowledge on the concept that we have learned so far. Okay, let's have a look at those. It says that ABC Limited, a company covered in mandatory phase one of Ind AS applicability, holds an equity investment in an LLP, which it classifies as a joint venture under Ind AS 111, which is joint arrangement, and it measures its investment in subsidiary, joint venture, and associated cost. The question is, how should it show in it investments in the separate financial statements, right? Now, the moment it says the accounting policy is to measure all such investments, including that of a joint arrangement, at cost, then by default, this is the only option available. Right? We talked about the basis, the type of investment that you have, be it a subsidiary, be it a joint venture, be it a joint array, joint operation, or an investment in associate. You can either use a cost method, or let's say using the fair value as per Ind AS 109. So as the applicability comes, since the company is already using the investment at cost, right? All such investments, there's no other option but to use cost model only. All right. Let's have a look at the formal solution. The question also says, by the way, when should ABC recognize profit share from LLP? When, for example, the right has been established. That's where you start looking at the calculation or the measurement of those, right? As we have provided as a solution, it says that Ind AS 27 provides that when an entity prepares separate financial statements, you may either show these investments at cost or as per Ind AS 109, right? Now, since we are provided that all the investments are shown at costs, there's no choice but to, of course, show it at, of course, the cost model, or show it under the cost model only, right? The accounting for the return would be so recognized when the right to receive the profit share is established. All right. Let's have a look at this question, or this was tested. This is adapted from November 19, 2017, right? So this question suggests that Rohtas Limited has a subsidiary named B Limited and is preparing consolidated financial statement as on 31st of March 17. On 10th of May 16, Rohtas acquired 40% of shares of Amit for 45 lakhs. And by virtue of this, it can exercise significant influence. So it's safely an investment in associate. All right. During the financial year ended 31st of March 16, so we're talking about the previous year, Amit Limited earned a profit of 11,54,000 and declared a dividend of 2,48,000 on 16th of September 2016. And finally, Amit's reported earnings of 26,26,000 rupees were there for the year ended 31st of March 17, and also declared a dividend of 9,85,000 on 17th of August 2017. The question is, calculate the carrying amount of the investments in the separate and the group financial statements for the year ended 31st of March 2017. Okay, so what you want to remember here, first of all, is that 10th of May 16 is the date when you acquired the stake in Amit Limited for 40% shares, right? For the 40% shares in Amit Limited at 45 lakh rupees. So this is essentially the cost. Okay. And then we are saying that, this is done on 10th of May 2016. So we're talking about the year 1670, right? But now during that year, so there's a profit which was already earned. So that's not relevant. So this is not relevant since it is pre-acquisition. Okay. It says that there's a dividend of 2,48,000 rupees, which is declared. So essentially, 2,48,000, let's do the calculations. So 248,000 into 0.4, 99,200, right? So the share of dividend is 99,200. Basically, it's 40% of 2,48,000, right? That becomes, of course, an income, right? That's an income for, Rohtas Limited, right? So that's where it becomes an income, as a part of, the financial statements. And then we are talking about also that the reported earnings for the year ended 31st of March 2017 are 26,26,000, which means that you take again the 40% of that value, which comes at 10,50,400. Okay. Effectively, what is happening that you made an investment at 45 lakhs. You received an income of 99,200, right? In terms of a dividend, right? And then you're talking about, of course, also a share of profit. Okay. A share of profit, let's say on, for the year ended 31st of March 17, right? So effectively, we are talking about here that your original cost was 45 lakh, okay? And then there is a share of profit, 10,50,400, right? But then you also recovered a dividend of 99,200. So this gives us a total of 54,51,200, right? Now, this is something which would apply as far as the group financial statements are concerned, right? You would recognize your share of profit, and you, of course, would reduce any dividend received, which is basically the repayment of, let's say, or a recovery of your investments back, right? Something that we have talked about in, Ind AS 28 as well in the past under the equity method of accounting, right? Now, as far as the separate financial statements are concerned, we are saying that you may continue to show it at 45 lakh rupees if, for example, using the cost method for this. All right. The question also, by the way, asks us what is the carrying value of investment if prepared on 31st of December, 31st of August 2017. Now, the only difference that lies here is also a dividend of 9,85,000. So let's use that. The 40% of that would be 3,94,000. Right? So if there is a recovery of that dividend also, so from this 54,51,200, we shall reduce 3,94,000, which gives us 50,57,200 as a part of the carrying value from a group or consolidated financial statements perspective. All right. Let's have a look at the formal solution around it. We are given that The investment is, of course, at cost, which is 45 lakh rupees. As far as the carrying value is concerned, for the year ended 31st of March 17, we are looking at 54 lakh 51,200. And finally, the carrying value of the investment after the dividend has been realized is 50 lakh 57,200. Importantly, we are not provided how much is the profit which the entity has made. So that has been ignored for the calculation purposes. All right. That's it from my side on this standard. Thank you very much.